The stock market is like a giant auction. Companies issue shares, which represent ownership in the business. Investors buy and sell these shares. Prices go up when demand is high and down when it's low. Think of it like your favorite toy. If everyone wants it, the price goes up. If nobody wants it, the price goes down. The stock market works the same way. It's important to remember that the stock market is always changing. Prices fluctuate based on many factors. Understanding these factors can help investors make informed decisions. Tariffs are essentially taxes on goods brought in from other countries. Governments implement tariffs to protect domestic industries and jobs. For example, imagine a country that makes a lot of cars. They might place a tariff on imported cars to make them more expensive. This encourages people to buy domestically produced cars instead. Tariffs can impact various industries and goods from electronics to clothing. Tariffs can significantly impact a company's bottom line. When tariffs are imposed on imported goods, the cost of those goods increases. Companies that rely on imported materials or components may face higher production costs. This can squeeze their profit margins. Some companies may pass these increased costs onto consumers through higher prices, potentially impacting demand for their products or services. Tariffs can influence stock prices in several ways. When a company faces higher costs due to tariffs, its profitability may decline. This can lead to a decrease in its stock price. Investors may become concerned about the company's future earnings potential. Additionally, tariffs can create uncertainty in the market. This uncertainty can make investors nervous and lead to stock market volatility. Section 5. Understanding bonds, loans to the government. Bonds are essentially loans that investors make to governments or corporations. When you buy a bond, you're lending money for a fixed period. In return, you receive regular interest payments and the principal back when the bond matures. Government bonds, particularly U.S. Treasury bonds, are often considered among the safest investments. This is because they're backed by the full faith and credit of the government. Section 6. Why bonds can be considered a safe haven. Investors often view bonds as a safe haven during times of economic uncertainty, such as when tariffs are imposed. Unlike stocks, which can fluctuate significantly, bonds offer more predictability. The interest payments and principal are predetermined. This stability can be attractive to investors looking to preserve capital and generate income. When the stock market is volatile, bonds can offer a sense of security. Section 7. Stocks and bonds in a high-tariff environment. In a high-tariff environment, stocks and bonds may behave differently. Stocks, particularly those of companies heavily reliant on international trade, may experience volatility. This is because tariffs can impact their costs, profitability, and ultimately, their stock prices. On the other hand, bonds, especially government bonds, may be perceived as a safer investment. Investors seeking stability and predictable returns may turn to bonds during times of uncertainty. Section 8. The interplay of tariffs, bonds, and stocks. It's important to remember that tariffs, bonds, and stocks are all interconnected. Changes in one area can have ripple effects on the others. For example, if tariffs lead to economic slowdown, this can impact company earnings and stock prices. Conversely, if investors flock to bonds seeking safety, this can impact the stock market as well. Section 9. Conclusion: Navigating market volatility. Understanding the relationship between tariffs, bonds, and stocks is crucial for investors. Tariffs can introduce volatility into the stock market, impacting company profits and stock prices. Bonds, particularly government bonds, can offer a sense of stability and predictability during uncertain times. By staying informed and diversifying their portfolios, investors can navigate market fluctuations and work toward their financial goals.